Hey, so what's up, everybody? And thank you for joining us. Today, Jack and I will be sharing an update on Fund I and what is up next for JKAM, including Fund II in our 2022 outlook. I am William Bonati, partner in the JKM Fund, and I'm obviously joined by Jack Krupey, principal and founder. Jack, how are we doing today?
Doing great. Excited to share some of this exciting news with our investors.
Yeah, absolutely. So to get us started, why don't you give us kind of an update on where we are with Fund I as of today?
Sure. So we launched Fund I just the last few days of September of 2020. That was our first investment allocations, and we sit here today in mid-February, and we've made over 30 allocations into individual properties. A few of them were pooled together in funds, but a majority of them were individual syndications. Over 80% were multifamily. We have a few student housing allocations, and we have one ground up senior housing and a very interesting condo conversion. So I was really proud of the allocations we've made in Fund I. And with a combination of the value add component of these properties that we've executed with our partners, many of the properties with renovated units, the rents are up over 30%, and that adds significant value to the portfolio. So really exciting, and just given the way the fund is structured with our 70-30 profit split, it just makes sense to close Fund I to new investments and start the return of capital in the coming months. So what that means is up until now, our investors have been receiving their preferred return payments paid every quarter, and those payments have been made on time like clockwork since the fund started in 2020. Moving forward, in addition to paying the preferred return, we will begin to start returning capital as well. So when an investor logs into the portal, they'll actually see two line items. One item will be their preferred return for that quarter, and another line item will be a return of capital. And the preferred return in future quarters will then be calculated on the amount of capital that is unreturned. So we have provided most of our investors a chart that was an estimate of what that would look like. But now that it's happening, I'll encourage any investors to, if you have any questions, feel free to reach out to anyone on our team. We could walk you through the Syndication Pro portal exactly how to see those numbers. And the last point is that we are, for a period of time, going to continue to leave open the 10% share class. It's very simple. It's 10% paid quarterly, or 10% annually, paid quarterly, but there's no participation in the profits. So that 70-30 profit split, just once we close the fund, we can't let anyone else in for just contractually in the way the fund is structured. Given where we are in the market, where yields are, anyone interested in 10%, we still have that opportunity available.
Yeah, that's a great opportunity for those looking to beat inflation in a safe place. Jack, why don't you can you share with us? We had a lot of questions around timing on return of capital and what that looks like. I know that we've had some internal conversations that a few assets may be selling or closing or exiting a little sooner than we anticipated. Do you have any additional color for the group on that?
Sure. So we never know for sure until a contract is signed and closed and the money is in the bank. But a number of our assets had received unsolicited offers, and in some cases the offers were for higher than the projected 3-year sale price, in many cases less than a year. So there's a few assets that have been held even less than a year that once we hit the 12-month time frame, where it would be a long-term capital gain instead of a short-term capital gain. There is a chance a few assets are going to exit earlier than expected. Very similar to our Phoenix asset, which sold in 12 months and 2 days. That was an exact same scenario where it could have probably sold a month earlier, but it made sense to structure the sale to at least wait 1 year. So what that means for return of capital, it really depends on what sells, but it's not out of the question that 10 to 20% of capital may be returned during 2022. And potentially, if not 2022, a more significant amount of capital may return in 2023.
Yeah, awesome. Thanks for sharing. So we're going to have the 10% share class open. Do we have any timeline on when that'll be available till, or is it kind of?
Probably for another few months, and it really it also depends on Fund II's structure. So probably a good time to segue.
Yeah, absolutely. Why don't we jump
II.
into that? So what does Fund II, or why don't we share what Fund II structure and what that's going to look like for our investors?
Sure. So Fund II in a diversified fund is going to be very similar to Fund I. We're providing either a 6% or an 8% preferred return, and the same 70-30 profit split, meaning investors get 70% of the profits for essentially until every asset is sold, and we only get paid once our investors have received their preferred return and all of their capital. We do have one other share class that is closer to a fixed return, and that is a 12% fixed. And with that 12% fixed, 6% of it is paid current, so a quarterly distribution of a 6% annual return, and the other 6% is paid at the sale or refinance of a property. So one of the things happening in the just given where the economy is at, given how red hot real estate is it's getting harder and harder to find deals that pay a current pay above a 10%. A lot of investors used to invest in bridge loans or hard money or fix and flip loans to earn a higher interest rate. But the fact is those loans now are down to, in some cases, 8%. So we wanted to give investors that are looking for a fixed rate the ability to get it, but it's broken up into two components, just a 6% current pay, and there's a catch-up payment to get to a 12% annual. So it's the first time we're offering something of that structure, but I think just based on discussions with certain investors, it's an option we wanted to put together for our investor base that's looking for just
a fixed
to know
rate.
Exactly what they're going to make.
Yeah,
a fixed
know
rate.
exactly what they're going to get, and it makes sense for a lot of the qualified money as well, right?
Exactly.
Awesome. So in addition to Fund II, we have some exciting news as well to share with what we're going to be doing alongside Fund II in terms of giving our investors the opportunity to participate directly in individual deals. So Jack, maybe you want to speak a little bit to that.
Sure. So it's very exciting. We have a base of investors that likes the diversification, but we also have a number of investors that like to really dive in on individual deals or like certain markets, and maybe want to be invested in the fund, but also go kind of put extra money into select deals they like. So we have a platform to do that as well now, and it's going to be called the Jkm Flexible Allocation Fund. And what's exciting about it is the way the fund is structured. It's closer to a brokerage account where investors can pick and choose which investments they want to invest in and for how much money. And after the initial minimum is going to be $50,000, but after the first investment, there's going to be opportunities to potentially invest even less than $50,000 in future deals. And it really opens up a lot of flexibility for us. One of the bigger challenges of doing individual deal by deal syndications was just the legal and the compliance for smaller offerings. And this new platform solves all those problems. So Investors are going to be able to have a number of options in a number of markets to invest in, as well as to continue to invest with the diversified fund, across and almost, I'd imagine almost every deal that's marketed deal by deal, the diversified fund will also be investing in. So it'll give investors the option to really invest either with the diversified fund inside of it or alongside the diversified fund, or a combination of both.
Yeah, I mean, we had a few investors that wanted to participate in just the direct project or the individual project, and not necessarily the diversified fund. And then also we had investors that wanted to participate in the diversified fund, but also wanted to make a greater allocation to an individual property. So it gives a lot of flexibility and options to our investor base going forward. So that's an exciting development for us in 2022. Why don't you, Jack, you mentioned that it's getting, with the way that the market is going, it's getting harder to find opportunities and projects that have, that 8 to 10 or 8 to 12% current pay or cash on cash. So what are we looking at for 2022 in Fund 2 in terms of allocations? Like what type of assets?
Sure. So we've been to a number of industry conferences over the last few months. So a lot of our allocations are really based on just our own data, because we're in 30 plus projects right now, and we're monitoring hundreds of deals through our partners in various markets. So multifamily is still going to be a big component of our investment base, especially the workforce housing, which has been at the forefront of the Fund I's investments. And we're still bullish on that asset class, especially with inflation, especially with the cost of materials, the supply chain issues. We're still buying these properties well below replacement cost. So, it is an asset class we're going to continue to invest in. The challenge is that due to the amount of money chasing deals, the actual entry cap rates are continuing to compress, and it's just a very competitive market. And with the heavy value add, which is generally the type of asset that yields the highest returns, the first year most of the money is being put towards increasing the rents and renovating the units. So there's not a lot of cash flow available to pay immediate preferred returns.
Yeah.
And a good part of our investor base wants that mailbox money, and that includes myself. Actually, I don't live off of the fund's management fees. I live off of the passive income from the rents. So this is something I need personally as well. And one of the points that we always make with this fund is you're investing alongside myself. I built this fund basically to allow other people to invest alongside me, because I was putting my own money into these deals anyway. So in addition to multifamily, we've always had the ability to do mobile home and storage, which are both very recession resistant. And we'll, just because of the run we had with multifamily and just got a string of really great deals, we just didn't allocate as much to mobile home and storage as we might have originally planned. Not because of anything wrong with those asset classes. Those asset classes do tend to have a little bit higher current cash flow. So in Fund 2, I would expect to see some allocations into multifamily and storage. Triple net leasing, which is very much slow and steady, but current cash flow. So those deals will spin off maybe a less of an overall IRR. So it doesn't look as exciting as 20% or 99% in the case of our Phoenix deal, but it will pay a current coupon. And from month one on, it's spitting off cash flow. So we're going to be balancing the portfolio with some more cash flow producing assets.
Awesome.
And
yeah, thanks.
Yeah, and then one last component is there's a number of funds that have been buying, similar to our Fund 1, that had been buying assets since 2021 that have built-in appreciation already. So one of the other components you may see in Fund 2 is more of a fund of funds, and these groups will give us preferential terms because we're coming in for a larger dollar amount. So, one of the ones we're looking at now has assets from early 2021 that are already up 30% plus in value. and we have the ability to get in 2022 based on 2021 pricing. So that's something we'll likely see in Fund One. I think that's a very good hedge because we're buying 2021 assets, and also going forward, in addition to those, we're constantly monitoring the market. So as interest rates move, the benefit of the diversified fund is that as rates move, we can adjust our strategy, every single week or month as we're looking at assets. So that includes looking at future sale prices. As rates go up, we're able to monitor, is the exit cap rate on track with where rates may be in 2 or 3 years. So the real benefit of coming in with us, as opposed to picking one deal, is if you pick one deal, you're in that deal, and if rates move and the projections weren't right, it's could be challenging. Whereas if you dollar cost average in with us over 10 to 20 deals over the course of a year, if rates move or if just the economy changes, we'll be adapting as the year goes on, so that regardless of what happens, we'll be in a good position.
Yeah, thanks, Jack. That's a really great point. But overall, you're still very bullish on multifamily, because of the fundamentals in the markets we're in. The strong population growth, the lack of housing. You mentioned the replacement cost. It still costs a lot more to build, new multifamily properties versus renovate. And then, what are your thoughts regarding the interest rates? I know you talked about that briefly, but
sure. So,
that's a frequently asked question. Everyone has an opinion on what's going to happen with interest rates, but maybe you could share your thoughts.
Sure. So, I mean, I'm pretty confident interest rates are going up. I think that's the general consensus. So we're planning accordingly. What I think is going to happen, though, is you still have supply chain issues, and I think inflation is going to still outpace interest rates. And there's still so much money chasing yield that I think interest rates will go up, but the cap rates, which is which generally move in the same direction, I do not think cap rates will expand as much as interest rates go up. Meaning investors will continue to work for a slightly less return in the future because of just so much money that's been printed.
The amount of equity looking for, Yeah. I mean, the debt will still be there, right? But there's a ton of equity looking for a home. So
correct. And look, over the course of history, interest rates in general have been in that 4 to 5% range, not the 3% that they've been for the last 4 or 5 years. So if anything, we're returning to a more of a sense of normalcy, and that may also bring good buy opportunities as well. With rates a point or two higher, the market will make some adjustments, and there could be some opportunistic purchases in the future as well. If the market just normalizes as opposed to somewhat of a frenzy over the last year or two in certain markets.
Yeah, maybe a little bit of a shakeout of those operators that were really pushing the numbers to make those deals work.
That's really the biggest risk is people that are overly aggressive using bridge financing. For example, the most recent deal we allocated to is only 67 loan to value and has fixed rate debt from Fannie Mae. We are in some bridge deals. Right? No, and that's not, we are in a few deals with bridge, but the deals with bridge that we're in are value add, where the operators have proven themselves that they can renovate units very quickly, and we're generally out of the bridge either through sell or refi within a very short period of time.
Yeah, and they also purchase caps, interest rate caps.
Correct. There's interest rate caps, and with when you're moving rents from the specific operator that I'm mentioning that we did well on the Phoenix deal, and we're in other deals in Vegas and Dallas with. They're moving rents from $1,050 to $1,400. So within 3 to 6 months, these buildings are worth 10 to 20% more than purchase. So there's a lot of value increase very quickly, and that really does take a lot of the risk off the table. With these structures.
Yeah, and another point there too, Jack, is that a lot of the operators that we've allocated to have been pretty conservative on their underwriting, and that's all great. Everyone says they're conservative on their underwriting, but when you're averaging between 2 and 4% rental growth on your underwriting, and you're seeing double-digit rent growth, that opens up a lot of room, right?
Yeah, absolutely. Yeah. I mean, many of our deals, the rents are up 30 to 40%, but that's based on overall dollars. But a lot of them, the actual growth is 10 to 15% above the pro forma projections as well.
Mm-hmm.
So it's it's been a really good run with a number of very strong operators, and we're excited to continue this for Fund II, both on both providing diversification, and for select deals, the ability to come directly into an individual offering.
Yeah. So Jack, you mentioned continuing multifamily, self-storage, maybe mobile, triple net lease, and are we looking at industrial? Is that in there?
Yes, I actually made a personal investment into an industrial deal. It wasn't something we highlighted in Fund I, but it's a very very hot asset class, and it's been for a number of years. And I think it just makes sense with the Amazonification of the economy.
Yeah. E-commerce.
Just shipping, logistics, e-commerce. It's a great asset class. It's growing. There's certain markets, there's a limited supply of industrial space with increased demand. So it's a great opportunity.
Yeah, another asset class that we'd look at. I just wanted to mention that.
Yeah, and we did not highlight. We are in a ground up deal in senior housing. There could be some other, a small allocation to ground up opportunities. I generally like those deals, and frankly, the only reason we probably won't do more is just the cash flow situation. Many of our investors, at least in a diversified fund, want cash flow. I think in the individual allocation, flexible allocation fund, I think we may see a number of ground up opportunities where the returns can be much higher, but what you sacrifice is cash flow for the first year or two. So that's going to be exciting, because there's great deals that we perhaps haven't pursued.
We passed on because they didn't have current cash flow.
Yeah.
There's a lot of development deals like that. I mean, there's a ton of momentum in the build to rent space.
Yeah, absolutely.
But not ideal for our fund, because we need that current cash flow. So that'll be great, because there's tons of really good opportunities that are strictly growth that you'll be able to participate in on a direct project by project basis. So anything else that I'm missing that we want to talk about for 2022?
No, I think that's, other than that, we're hoping to launch Fund II by early March. So, we're excited to put that out. We're hoping to touch base individually with all of our current investors, just to make sure they, know the success we're having in Fund I, and how to plan for the potential return of capital in the coming months, and just to get some feedback on how they're doing, are we helping meet their goals? Is there anything else we can do to help our investors? And anyone else who's listening or who's been on our mailing list, we're at a stage where we want to, we're looking to engage with the community. So I'm hoping this video is helpful, and really encourage everyone to reach out through the website, directly to either of us, social media, and it would be great to connect one-on-one and understand what your investment goals are and how we may be able to work together to help you meet them.
Yeah, absolutely. Awesome, Jack. Thanks so much for taking some time to share Fund I updates and the exciting news about Fund II and 2022. Unless you got anything else for us, we'll wrap it up for today.
Yeah, let's wrap it up, but we'll be more active, and the podcast is going to be launching at some point next month or two.
Oh,
also.
yeah.
So that's
That's the big news there too, huh?
Yeah.
So why don't you share sort of the name of the podcast and sort of what the purpose of that will be.
Sure. So the podcast is going to be called The Alternative Investor Mastermind, and it's really about helping investors create wealth without Wall Street. And we're going to be talking about various alternatives, everything from the real estate and syndication deals, which will be a bulk of it. But we're also going to talk about other alternatives, a little bit of crypto, Bitcoin. Being down here in Puerto Rico, I'm surrounded by a lot of crypto enthusiasts. So we're going to be a little broader in addition to real estate, and really help people learn about all of the options outside of the traditional stocks and bonds.
Yeah, just a lot of other interesting stuff that isn't mainstream, so to speak. I'm hoping that you're going to
let investors hear. Oh, sorry, Will.
I'm hoping that you're going to do a podcast on credit cards and the points game.
Yeah, that's the other part of it too. Yeah. I mean, ultimately, it's going to be really just opening up a little bit more. I also have a number of personal investments outside of real estate as well. So, it's really going to be, somewhat of just an open book of what I'm investing in, what I'm looking at. For example, I made an oil and gas investment last month. And, I did that because a number of our investors are high W-2 earners. And there's actually some different tax incentives for oil and gas that don't limit passive losses. So could allow, a 7-figure earner to potentially offset their W-2 income. So there's things I explore personally at a small scale just to learn and to, potentially bring that knowledge to the community. So that's the type of thing you're going to see, across the board. And then the lifestyle side of it too, that you mentioned. I'm a big points and miles enthusiast, and part of this, the whole alternative assets and passive income is, what do you do to enjoy it afterwards? So, being a business owner, it's great to be able to take advantage of the credit card expenses when you have them, and take amazing vacations in style with just by being efficient with the way you spend your money.
Yeah, and taxes, right? I mean, you moved to Puerto Rico.
Oh, absolutely. Taxes will be a big component of it. So yeah, it's going to be exciting, and you're going to be a big part of it as well. And it's hopefully people enjoy it.
Yeah, awesome. Thanks for sharing. So keep a lookout for Jack's podcast coming out, and then also Fund II. So awesome, guys. Thanks for joining us. Hope this was informative, and we'll talk to you all soon.
Thanks, everybody.
Okay. See ya.